Charlie, what's up with the markets? Why didn't we get a bigger reaction?
I think you guys nailed it, right? This is what I call a neon swan. This is something that we've been watching for quite some time, anticipating for quite some time. Over the course of 2022, the BOJ kept their yield curve target. They kept easing while the rest of the world tightened. We saw that move play out certainly on the currency side with regards to the explosive move higher in dollar yen. Now people have positioned for this trade. It became an inevitability, and really it was a matter of when, not if. That is the surprise here, because we thought it was going to happen after Kuroda's term ended in April. That part was a surprise. I think people probably figured there was a 5-10 bips increment to this instead of a 25 bips increment, but it's the beginning of a larger normalization process that has been very much pushed back on in the press conference from Kuroda himself, saying this is not tight.
Let's pick up on that, Charlie. Out of interest, the Nasdaq just went positive. Why is this a shift? Very clear in the press conference that it wasn't. Why isn't this a move designed to make the policy more sustainable? What we've seen over the last few days is the ECB and the Fed both sounding super hawkish, and as a result of which, why isn't this just an adjustment that means that current policy can continue for longer?
It was a pressure release, and it was a pressure release focused on the market as opposed to what still clearly is an underlying macro case, the nominal growth story, the above-trend price inflation dynamic in Japan is a real one. But at this point, they had to true up the 10-year part of the curve with the rest of the curve in JGBs and the fundamental story there, because there is going to be more normalization that follows behind this. This first move was the one that seemingly would get things going. Frankly, if we treat it like equity vol has acted over the course of the year, this is a sell the news event. So you actually realize the event itself and you take profit on that first leg of the trade. I think people will still keep their shorts on in JGBs to a certain extent. I would prefer to play this with anticipating dollar yen to move lower, especially once the Fed begins to pivot their message at some point next year. That's when you should see that bigger move kind of down into 120 dollar yen.
Wow, 120, okay. So you'd be shorting dollar yen then on this?
Yeah, I like to play that through options, but so many people want to play short dollar into next year, right? Past peak Fed, past peak rates, past peak inflation. I think the cleanest way to play this is through yen strengthening, because again, there's a positive, virtuous backdrop. So much of the past decade's worth of the U.S. exceptionalism trade was this idea of cleanest dirty shirt. In this case, Japan is actually a viable alternative right now, just in light of the economic velocity that is happening there. So this is the way that I would prefer to play that short dollar trade.
Charlie, I'm sure there is the potential for error here. Where do you think it lies? This is going to be this is one of the biggest experiments in monetary policy we've ever seen. Exiting it from it is going to be difficult and it's going to be challenging. And I'm wondering where you think the potential problems could lie that could blow up, and how sort of significant and potentially systemic could they be?
So the trillion-dollar question is going to be what happens with these flows out of Japan, the repatriation or the possible repatriation of these flows. Japan has been the world's largest capital exporter, really, over the past decade. And whether that was European sovereign bonds, FX hedged, whether that was the U.S. CLO market, whether that was private capital, private equity, venture cap, things like that. If that money were to come back home and repatriate, which per our data has already begun almost a year ago, frankly, so this is not a new flow necessarily, but if that were to accelerate, it might actually come in a second order fashion with some of those sources of demand that we've gotten used to over the past decade, past 5 years, now actually turning into an outflow and potentially moving back in to Japanese fixed income or even equities markets. That's where I think you could actually have an accident. Just because in certain markets, i.e. the CLO market, Japanese investors became an absolutely enormous part of the overall source of demand story in recent years.
What's the possibility of a danger like that? And do you have to kind of prepare for that?
Sure. Well, we already knew that a space like structured credit, a space that is a floating rate universe like CLOs and leveraged loans, were going to be at risk of accident in this type of tightening environment. Now you've moved from kind of that rates risk now, I think, from a market's perspective, now into the recession risk, right? The credit cycle risk, the economic cycle risk. If you pair that with the potential, too, that you have an outflow from that space, that's where this could turn into something, start rolling downhill and turn into something bigger.
Does it complicate the job for the Fed? Does it complicate the job for the ECB? Or does it potentially make their jobs easier, do you think, Charlie?
Well, the way that I look at this is from a currency perspective. And if you think about the dollar strength story last year, over this past year, let's say, where the dollar strength became this wrecking ball, we were exporting inflation to the rest of the world. So much of the past decade, foreign central banks and FX regulators were concerned about their currencies and would intervene in the opposite direction. Over this past year, they've intervened for stronger currencies, stronger domestic currencies, because it would help with their inflation problem. Now that the dollar is seemingly past peak and weakening, if the yen begins to strengthen meaningfully, that also becomes an issue for the rest of the world if that means that their currencies then begin to depreciate versus yen. Because again, the Japanese economy is substantial and is a massive exporter in the global economy.
Do you want to buy Japanese equities here? Is it that simple?
I do. I like Japanese equity upside. I specifically liked, and Guy was speaking about the European banks earlier, in light of this being the first move of this potential kind of resetting of risk premia and Japanese rates, where volatility has been artificially suppressed by YCC now for almost 8 years, 6 years, excuse me. So in this case, I want to take advantage of industries that can borrow here to lend higher, types of things like that, net interest margin, things like that. So banks I like a lot. Topic's Bank's upside has been insatiable upside demand from clients in recent months, anticipating this very trade that we talked about, this loosening of the YCC band. I think that makes sense because, again, it's not just playing this market technical, it's playing the fact that there's a nominal growth story in Japan.
Am I selling US equities to fund that? Am I selling European equities to fund that? Where does that trade come from?
Yes, I think that there is real meat on the bone with this rest of world story and the decade of the U.S. exceptionalism trade. I think it does become potentially a source of funds where it's simply more nuanced than it used to be. It was all U.S. out of rest of the world forever. Europe still has a lot of structural issues, so you're down to just a few developed economy options. Japan looks particularly attractive in that sense. Europe, to me, still seems to be a rental. I think at one point, the VGK, right, the European ETF, at one point was up 23% quarter to date, and just got absolutely slaughtered in the kind of post ECB and post Fed hawkishness of last week. To me, that's going to be hot money in and out, playing potential dovish or hawkish inflections in European data, Russia, Ukraine, the energy crisis, gas usage and gas inventories. There's a lot of noise there. I think people will feel more confident deploying into a Japan, as well as certain emerging markets, as expressions of that short dollar trade, which was such a theme in 2022. I think now we expect some air to come out of that in 2023.
Yeah, I definitely feel like EM is becoming sort of the hot trade for next year, what everyone's saying. Before I let you go, just to go back to the OJ for just a moment, did you feel like Kuroda sterilized this move by also at the same time announcing bond purchases? Like, what was up with that?
Right. That was his intent. I think in some ways the fact that they did this now to surprise markets was absolutely an acknowledgement and an alignment of their policy now beginning with the rest of the world. He could have made it a victory lap, I think, as far as their economic goals being achieved with regards to price stability. He did not, for that very reason that you set out of the gates. You can't create your own bond crisis, and he still wanted to iterate. This was not a tightening. They did not adjust the policy rate. The monetary base has not been adjusted. They don't want to tighten liquidity. This was a market-based move.